Good afternoon, traders. Let's discuss the afternoon market update. So, first, the US dollar. So, the economic data and the Fed minutes this week will be viewed as a more dated than usual after Trump's reciprocal tariff plan. If higher and widespread tariffs are implemented as currently planned, it will increase the possibility of inflationary pressure in the coming months. This will create a more challenging environment for the Fed. The US labor market will need to loosen further higher unemployment to create room for the Fed to cut rates before June, as US rate markets are currently pricing in. We expect the minutes to confirm that the Fed held off at this March meeting awaiting details of Trump's tariff plan. So now the crude oil. After Brent crude suffered a heavy blow last week, market turn oil continued this week. European markets were also under pressure yesterday, with Brent crude and stocks falling simultaneously. Trump had previously threatened to impose an additional 50% tariff on Asian goods, bringing the total tariff level on Asian goods exported to the United States to more than 100%. It is worth mentioning that during Trump's first term, Asia's share of US imports has declined and is currently around 13%. Given the increasingly hostile tone between the United States and Asia, the risk of a global economic recession has further increased, making the market more pessimistic about the outlook for crude oil demand. Currently, China has not imported LNG from United States for two consecutive months, setting a record for the longest interruption since the last trade war. At present, there are signs that Asian crude oil importers will also suspend purchases of US crude oil. Asian companies are expected to turn more to Russia, Middle East, and some oil producing countries from West Africa and South America to meet their crude oil supply needs. Now, let's talk about everybody's favorite, which is gold. Gold's safe haven role has been temporarily undermined with the spike in the volatility fueling another wave of deleveraging similar to but not nearly as large as the early days of 2020 pandemic panic when gold plunged 13% in 10 days before rebounding strongly as inflation fears and stimulously helped create new demand. However, factors such as rising global economic tensions, stagflation risk, and a weaker dollar and lower US yields due to rising inflation expectations will continue to support gold and to a lesser extent silver. In addition, the market is now actively positioning to further rate cuts this year, currently expected to be nearly 100 basis points by the end of the year. Thank you.